This video is for educational purposes only and does not constitute financial advice. Consult a licensed financial professional before making investment decisions. It's 7:43 in the morning and Jake is sitting at his kitchen table, still in his work clothes from yesterday, a half-eaten bowl of cereal going soggy next to his laptop. He's not looking at the news. He's not checking his email. He's staring at his Fidelity app, watching the number in the top right corner get smaller. $47,200, $46,900, $46,600. 3 days ago, that number was $52,000. He worked 5 years to get to $52,000. And now, every time he refreshes the screen, it drops another $100. His coworker texted him that morning, "Bro, did you see what happened with Iran?" He hadn't. He was too busy watching his retirement evaporate in real time. And sitting there, spoon in hand, cereal getting cold, he makes a decision that will cost him more than the crash ever did. My name is Finn, and I think about money probably more than I should. And look, if you've been anywhere near a financial news app in the last week, you know exactly how Jake feels. The Dow dropped over 1,000 points in a single day. Oil surged, bond yields climbed. The word WW3 is trending on social media for the first time in years, and it's not being used sarcastically. People are scared, and honestly, some of that fear is rational. But here's what nobody's telling you. The decisions you make in the next 30 days with your money will matter far more than what happens on a battlefield 10,000 miles away. Not because the geopolitical situation isn't serious. It is. But because the biggest financial damage in a crisis doesn't come from the crisis itself. It comes from people doing exactly what Jake did, making permanent decisions based on temporary fear. If this is the kind of breakdown you've been looking for, no panic, no hype, just the actual math of what to do with your money right now, hit subscribe and drop a like on this video. It costs you nothing and it tells the algorithm this content matters. Because here's what I want to walk you through today. The smartest order to protect and position your money before things get worse. Not what to buy, not what to sell, the order. Because that sequence, what you do first, what you do second, what you do third, is what separates the people who come out of this with more money than they had going in from the people who come out of this wishing they'd never touched anything. And the crazy part? History has already shown us exactly what that order looks like. We just have to look. Let's talk about where we actually are right now, because I think a lot of people are operating with incomplete information. On March 3rd of this year, the Dow Jones dropped more than 1,100 points in a single session. Oil surged. Gold, which was already at record levels above $5,100 an ounce, spiked even further. The trigger was an escalation of the conflict in the Middle East, specifically around Iran. And if you look at financial headlines from that day, the word you keep seeing isn't crash or panic, it's uncertainty. And that word is doing a lot of heavy lifting right now. Because here's what people are missing. This isn't happening in a vacuum. The American consumer is already under pressure in ways that make a market shock especially dangerous. The personal savings rate right now sits at 3.5%. The lowest level since October 2022, according to Federal Reserve data. That means the average American is saving just $3.50 out of every $100 they earn. Total credit card debt in the United States just crossed $1.28 trillion, according to the New York Fed's latest household debt report. And tariffs that were introduced over the past year have added an estimated $600 to $800 in extra costs per household, according to the Yale Budget Lab. Costs that Goldman Sachs confirmed in writing are not going away even if the tariffs themselves get cut. So we have a market in shock, a consumer with almost no financial cushion, and a geopolitical situation that nobody has a clear roadmap for. That's the environment Jake is sitting in at 7:43 in the morning, watching his savings disappear. And that's the environment you are navigating right now. But here's the thing, most people skip over. Every single time in modern history that a major conflict has triggered market panic. World War II, Korea, Vietnam, 9/11, Russia, Ukraine. The people who responded with a plan came out ahead. The people who responded with emotion got destroyed. And the plan isn't complicated, it's sequential. And it starts with a question almost nobody asks first. Think about this for a second. When your house is on fire, what's the first thing you do? You don't start moving furniture to a new location. You don't call your real estate agent to ask about property values. You get out and you make sure you have somewhere safe to stand. Everything else comes after that. Your financial life works exactly the same way. And step 1, the thing you have to do before anything else, has nothing to do with the stock market. The number one financial mistake people make when a crisis hits is they look at their investments first. They check their 401k, they open their brokerage app, they watch the number go down, and they panic. But none of that matters, and I mean none of it, if you don't have liquid cash set aside. Here's what that means in practical terms. The standard recommendation from every major financial institution, Fidelity, Vanguard, the Consumer Financial Protection Bureau, is 3 to 6 months of living expenses in cash in a high-yield savings account, not touching anything. That's not investment money. That's not opportunity money. That's your financial firewall. Here's what that actually looks like in real life. It's the difference between losing your job during a recession and being fined for 6 months versus losing your job during a recession and liquidating your retirement account at a 20% loss just to pay rent. It's the difference between an emergency room visit costing you $2,000 in cash versus $2,000 charged to a credit card at 21% interest that takes 3 years to pay off. It's the difference between watching the market drop 15% and staying calm because you have options versus watching the market drop 15% and selling at the bottom because you have no other choice. The personal savings rate in America right now is 3.5%. That means most people watching this video do not have that firewall. They are one car repair, one medical bill, one layoff notice away from making the worst financial decision of their lives. Not because they're bad with money, but because they never built the foundation first. Now here's where it gets wild. Let me show you why this number is so important. The average credit card interest rate in the United States right now is hovering around 20 to 21% according to Bankrate. That means for every $1,000 you're carrying on a credit card, you're losing $200 every single year. Guaranteed, no market crash required, no geopolitical event necessary, just the quiet, invisible tax of compound interest working against you instead of for you. Now think about what happens in a crisis. You're scared. You want to do something productive with your money. Maybe you've been reading about gold, about defense stocks, about commodities, and you start thinking, what if I take $5,000 and put it into something that's going to protect me from what's coming? Here's what nobody's telling you. The S&P 500 has returned an average of about 10% per year over the long term, and that's considered a great return. The most optimistic gold bull will tell you gold returns 8 to 10% annually over time, but you have credit card debt charging you 21% right now. Paying off that debt is a guaranteed 21% return on that money. There is no investment on the planet that consistently beats that. Let me put that in perspective. If you have $5,000 in credit card debt at 21% interest and you invest that $5,000 in the stock market instead of paying it off, you need the market to return more than 21% just to break even. The market has only returned above 21% in a handful of years in its entire history. Meanwhile, the 21% interest on your card is running every single day, whether the market goes up or down, whether there's a war or a peace treaty. The math doesn't care about your intentions. It rewards sequencing. Now here's the part most people skip over. Once you have your firewall in place and your high-interest debt under control, then we talk about positioning. And this is where history becomes your most valuable asset. Because here's the thing about wars and financial markets that most people get completely backwards. They assume that war equals portfolio destruction, and the short-term data is scary. Yes, the Dow dropped 684 points on the first trading day after 9/11. The market fell over 12% in the months leading up to World War II. When Iran escalated earlier this month, we watched 1,000 points vanish in a single session. That stuff is real, it's terrifying, and it's designed to make you make bad decisions. But here's what the history books actually show. During World War II, the most catastrophic conflict in human history, the Dow Jones Industrial Average gained 50% over the course of the war. 50%. The S&P 500 returned nearly 17% over that same period. During the Korean War, U.S. stocks rose 19%. During Vietnam, the S&P gained 29%. And here's the most important data point. Research from Ned Davis and Hartford Funds, looking at 29 major geopolitical crises since World War II, found that stocks were higher just 1 month after the crisis in 66% of those events. And on average, markets were higher still 3 months out. Think about what Jake did with that information. He saw the Dow drop 1,100 points and he sold. He converted a paper loss into a real one. And the moment he did that, he permanently removed himself from the recovery. Stay with me here, because this next part changes everything. The pattern is not random. Every major conflict in modern history has created a predictable rotation in which kinds of assets win and which ones lose. And if you understand that rotation, you can be positioned before the crowd figures it out. Here's what happens when geopolitical fear spikes. First, cash and short-term bonds surge because investors want safety. Now, they'll accept lower returns for certainty. Second, gold spikes because gold has been the world's oldest safe haven asset for 5,000 years. It went from $35 an ounce in 1971 to $850 an ounce by 1980, a period that included the 1973 oil embargo and the Soviet invasion of Afghanistan. Gold is already at record prices above $5,100 an ounce right now, and an escalating conflict in the Middle East is exactly the kind of environment where central banks and individual investors continue buying. Third, defense and energy stocks outperform. This is not speculation, it's documented. Lockheed Martin jumped 33.7% in the 2 years following 9/11, while the broader market was struggling. Energy stocks spike whenever Middle East conflicts threaten oil supply chains. And here's what most people get wrong about gold specifically. Research from FX Street shows that gold's biggest wartime gains tend to come before the war fully kicks off, in the uncertainty phase. Once the actual conflict begins, other economic factors take over. Interest rate policy, monetary easing, inflation expectations. The window to act is the uncertainty window. The uncertainty window is right now. But, and this is crucial, none of that matters if you skipped step 1 and step 2. Because here's what actually happened to a lot of people during the 2008 financial crisis, which was not a war, but created the same kind of panic. People who had no emergency fund and were carrying credit card debt looked at their options and decided the smartest thing to do was pull their 401k money and pay off their debts. So they liquidated retirement accounts at the bottom of the market, in some cases losing 30 to 40% of their portfolio value, to pay off debt that they should have addressed years earlier. And then, when the market recovered, which it did dramatically, they had nothing left to participate in that recovery. That's the sequence failure that ruins people's finances during crises, not the crisis itself. And this is the part that should make you a little angry. Because the financial media during a crisis is not helpful. The headlines are not designed to help you make rational decisions, they're designed to get you to click, to watch, to stay scared. The 24-hour news cycle profits from your panic. The algorithm rewards the most extreme prediction. And the financial industry? They'd rather you make reactive decisions that generate trading fees than patient decisions that compound quietly for 20 years. Before we get to the best part, the actual order, laid out step by step, quick favor. If any of this is clicking for you, hit like and subscribe. What comes next is the most actionable piece of this whole video, and more people need to see it. Now the real question is this: you know what to do, but do you know when to stop? Here's the mistake even smart people make in a crisis. They over-rotate, they get scared, they read about gold and defense stocks and oil, and they start moving everything into the crisis basket. They pull out of their long-term index funds. They stop contributing to their 401k. They go so far into crisis mode that they miss the recovery entirely. The research on this is clear. According to Dalbar's annual quantitative analysis of investor behavior, the average individual investor consistently underperforms the market, not because they pick bad stocks, but because they buy high and sell low. They chase performance, they flee panic, and every time they move money in and out of the market based on news headlines, they miss the best days of the recovery. Dalbar found that missing just the 10 best days in any given decade would cut your returns roughly in half. 10 days. Out of a decade, the market doesn't care that you're scared, it doesn't care about your feelings, it doesn't pause the recovery while you figure out when to get back in. Okay, here's the actual order. The smartest sequence for your money right now, specifically. Step 1. Your cash firewall. Today, if you don't have 3 months of living expenses in a high-yield savings account, this is your only job right now. That's it. Nothing else until this is done. Take whatever you were thinking of doing with your money this month and redirect it here. A high-yield savings account right now is paying 3% to 3.5% according to Bankrate, which, as I mentioned earlier, is actually a rare win because it's above the current inflation rate. You're not losing purchasing power by parking money here. You're buying time and options. Step 2. Attack high-interest debt like it's the enemy. Because it is. Any debt above 10% interest rate, and especially credit card debt in the 18 to 21% range, needs to come before any new investing. Every dollar you throw at a 21% credit card is a 21% guaranteed return. Nothing in a wartime portfolio consistently beats that. If you're carrying $8,000 in credit card debt, that debt is costing you approximately $1,980 every single year. That's $140 a month in pure interest. If you redirected that $140 per month into a low-cost index fund for 20 years at the historical average market return of 10%, you'd have roughly $100,000. The credit card doesn't just cost you $8,000, it costs you $100,000 of future wealth. Step 3. Don't touch your long-term investments. Seriously, if you have a 401k, an IRA, or a brokerage account in low-cost index funds, leave it alone. Do not sell. Do not rebalance into cash out of fear. The historical data is unambiguous. The S&P 500 has survived World War II, Korea, Vietnam, 9/11, the 2008 financial crisis, COVID, and every geopolitical shock in between. Every single time, the long-term investor who stayed in the market came out ahead of the person who panicked. Don't be Jake. Step 4. A small strategic hedge, 5 to 10% maximum. Once steps 1 through 3 are handled, then, and only then, you can think about positioning for the current environment. Historically, the assets that outperform in prolonged geopolitical uncertainty are gold and precious metals, defense sector ETFs, energy stocks, and short-term treasury bonds. But hear me on this. This is a hedge, not a transformation. 5 to 10% of your investable assets maximum. This is not go all in on gold. It's acknowledge that the environment is uncertain and add a small counterbalance to your portfolio. The difference between a hedge and a panic move is the percentage. A hedge protects, a panic move destroys. Step 5. Keep investing on schedule. Whatever you are putting into your 401k, your index funds, your Roth IRA, keep doing it. This is called dollar cost averaging, and it's one of the most powerful tools available to a regular investor. Think about it like this. If gas prices are volatile and unpredictable, trying to time when to fill up your tank is exhausting, usually wrong, and saves you almost nothing. The person who just fills up every Sunday, regardless of price, over time, gets a better average price than the person who tries to game it. Markets work the same way. Keep buying consistently. Let the math work. That's the 5-step order. It's not exciting. It won't go viral on Reddit. But it's what the data shows works. Every time, in every crisis. I want to leave you with 2 versions of Jake. Version 1, Jake sees the market crash. He opens his Fidelity app at 7:43 in the morning and watches the number drop. He has no emergency fund, just the $47,000 in his retirement account that he spent 5 years building. He panics. He sells everything and moves to cash to wait for things to settle. He watches the market recover over the next 6 months without him. He gets back in when he feels safe again, which means he gets back in near the top. By the time Jake is 65, he has $280,000 in retirement savings. He lives carefully. He can't afford to retire. He keeps working until he's 72. Version 2. Jake sees the market crash. He opens his Fidelity app at 7:43 in the morning and watches the number drop. He has 4 months of expenses in a high-yield savings account. He has no credit card debt. He has $47,000 in his retirement account. He reads the same headlines. He feels the same fear, but he doesn't sell. He stays in. He does nothing, which is the hardest thing to do. He even buys a little more because prices are lower now. He adds a small position in a defense ETF, about 7% of his portfolio, as a hedge. By the time Jake is 65, he has $890,000 in retirement savings. He retires comfortably at 63. He takes the trip he always talked about. Same income, same starting point, same crisis, different order of operations. The difference between those two Jakes isn't luck. It isn't talent. It isn't how the war ends. It's whether Jake built the foundation before he needed it. The market doesn't care if you're scared. It doesn't wait for you to feel ready. It doesn't pause the compounding while you figure out the news cycle. The only question is whether you're positioned to participate in the recovery or whether you're sitting outside it, waiting for a certainty that never comes. History doesn't promise that everything will be okay, but it does show, consistently and clearly, that the investor who stays calm, stays in, and stays on plan comes out ahead, every single time. The best time to build your financial firewall was 5 years ago. The second best time is before you close this video. If this changed how you think about your money, share it with someone who needs to hear it right now, because a lot of people are making permanent decisions out of temporary fear this week. Drop a comment and tell me, where are you in these 5 steps? I read every single one. And if you haven't subscribed yet, I break down the math behind money like this every week. Now's the time. This video is for educational purposes only and does not constitute financial or investment advice. Past market performance does not guarantee future results. Please consult a licensed financial professional before making any investment decisions.